Hello everyone, my name is Nico Jimenez, and today me and my group we are gonna do a presentation about our economic assignment taxes. The group is made up by Max Barrett, Nico Jimenez, and William O'Connor. Okay, let's begin. Different types of taxes. Taxes are visible in different types of situations. 1. Depending on the nature of the tax. 2. According to the destination of the funds collected. 3. According to progressivity. 4. Depending on the administration collecting them. 5. According to the taxable base. And 6. Special taxes. Okay, number 1. Depending on the nature of the tax. Here we have two different types: direct taxes and indirect taxes. Direct taxes. These taxes are imposed directly on the income or property of individuals or businesses. The main types are three: income tax, wealth tax, and inheritance and gift taxes. Income tax. This tax is charged on income earned by both individuals and companies. For example, a portion of your salary goes to ISR. Number 2, wealth tax. Include taxes on real estate and on net worth. For example, if you own a home, you may have to pay an annual tax based on the value of the property. And then number 3, inheritance and gift taxes. These apply to inheritance properties and gifts, where you will have to pay taxes on the value of what you receive. Secondly, indirect taxes. These taxes are levied on the consumption of goods and services. The main types are three: value-added tax, VAT, sales tax, and excise taxes. Value-added tax. This is a consumption tax that applies to most goods and services. For example, when you buy clothes, food, or pay for a service, the price you pay is generally include VAT. Number 2, sales tax. Similarly to VAT, this is a consumption tax that applies to sales of goods and services. The main difference is in how it is applied and collected on each transaction. And number 3, excise taxes. These are taxes on specific products, such as alcohol, tobacco, and fuels. Number 2, according to the destination of the funds collected. Here we have also two different types: ordinary taxes and finalist taxes. Ordinary taxes. These taxes are intended to finance general government spending. The revenue they generate are used for general government budget and are not intended for a specific purpose. Finalist taxes. These taxes are levied for the specific purpose of financing particular projects or sectors. An example will be a specific tax on fuels that is used exclusively to finance the construction and maintenance of roads. Number 3. According to progressivity. Here we have also three different types: progressive taxes, proportionate taxes, and then regressive taxes. Progressive taxes. In these taxes, the tax rate increases as the tax base increases. An example is people with higher incomes pay a higher proportion of their income in taxes than people with lower incomes. Proportionate taxes. The tax rate is constant regardless of the tax base. Everyone pays the same percentage of their income or profits in taxes. And lastly, regressive taxes. In these taxes, the tax rate decreases as the tax base increases. This means that people with lower incomes end up paying a higher proportion of their income in taxes compared to people with higher incomes. Number 4. Depending on the administration collecting them. Here we have three different types: national taxes, regional taxes, and local taxes. National taxes. These taxes are imposed by the central or federal government. Revenues from these taxes are used to finance national budget and programs that benefit the entire country. Secondly, regional taxes. These taxes are charged by the regional or provincial governments. And lastly, local taxes. These taxes are levied by municipal or local governments. They finance local services and projects such as street maintenance, waste collecting services, local police, and parks. Number 5. According to the taxable base. Three types: firstly, income tax; secondly, consumption tax; and thirdly, wealth tax. Income tax. These taxes are levied on income earned by both individuals and corporations. Two examples are the personal income tax and the corporate income tax. Secondly, consumption tax. These taxes are imposed on the purchase of goods and services. And lastly, wealth tax. These taxes are charged on the ownership and holding of properties and assets. An example is the real estate tax, IBI, which is the tax payable by owners of real estate based on the value of their property. And lastly, number 6, special taxes. Here we have two different types: ecological or green taxes and luxury taxes. Ecological or green taxes. These taxes are designed to promote environmentally sustainable practices and reduce pollution. A clear example is the carbon emission tax. And on the other side, luxury taxes. These taxes are liable on luxury goods and services generally consumed by high-income individuals. Their purpose is to redistribute wealth and fund public programs.
Hi, this is Max, and in this section we will compare the tax systems of multiple different countries: the United States, Canada, Germany, and Sweden. We're going to look at their tax income rates, corporate tax rates, consumption rates, and property taxes. And let's start off with the USA and Canada. USA has a federal income tax which is progressive, ranging from 10 to 37%. This means higher earners pay a larger percentage of their income in taxes. The corporate tax rate is a flat 21%, designed to be competitive to attract business investment. Sales tax varies by state, typically around 6 to 7%, reflecting the decentralized nature of the U.S. tax system. Property taxes are levied by local governments and vary widely. The reasoning behind the structure is to balance income redistribution with economic activity and autonomy. Comparing that to Canada, the federal income tax is also progressive, ranging somewhere from 15 to 33%. The corporate tax rate is 15% federally, with additional provincial tax rates. The goods and tax services tax is 5% federally, with provincial rates added to the HST. Property taxes are collected locally and vary by location. This system supports a strong social safety net while allowing for regional economic strategies. Both countries use progressive income taxes to balance income redistribution and economic activity. The U.S. has a flat corporate tax rate, whereas Canada combines federal and provincial rates, which can be flexible regionally. Sales tax in the U.S. is state-controlled, leading to variability, while Canada uses a federal GST with provincial additions for uniformity. Property taxes in both countries are locally managed, reflecting community-specific needs. In Germany, income taxes range from 0 to 45%, with higher earners paying significantly more. The corporate tax rate is around 15%, with additional surcharges and municipal trade exits. Municipal trade taxes. The value-added tax is 19%, with a reduced rate of 77% for essential goods. Property taxes are based on the value of the property. This tax structure funds extensive social services and regional development. Sweden has one of the most progressive tax systems in the entire world, with income tax rates that can exceed 60% for high earners. The corporate tax rate is 20.6% and the VAT is 25%, with reduced rates for certain goods and services. Property taxes are very low and regulated. The high tax burden supports Sweden's comprehensive welfare state, ensuring robust social services and equity. Tax competition is a significant factor in global economies. Tax havens like the Cayman Islands, Bahamas, Switzerland offer very low or zero corporate tax rates to attract multinational companies and impacting global tax revenues. Ireland, with its 12.5% corporate tax rate, has successfully driven down economic growth by attracting foreign investment. However, this raises concerns about fair tax competition and revenue loss in other countries. Now I'm going to talk about the social impact of taxes. We're going to discuss how taxes influence wealth distribution and fund redistribute policies that support social equity. Taxes play a crucial role in wealth distribution. Progressive income taxes reduce inequality by ensuring high earners contribute more. Wealth taxes target accumulated assets, promoting a more equitable distribution of resources. These measures help fund social programs and reduce social disparities. Redistributive policies funded by taxes are essential for social equity. Social Security and pensions, funded by payroll taxes, provide income support to the elderly and disabled. Public healthcare systems funded by taxes ensure equal access to medical services. Tax revenues also fund public education, promoting equal opportunities for all. for all children. These programs are vital for maintaining a fair and just society. Now, we've looked at how different countries structure their tax system and the social impact of these taxes. The balance between economic activity and social equity varies across all nations, but the goal remains the same: to fund essential public services and promote fair distribution of wealth.
Tax rates and their changes around the world, an analysis of global taxation trends. Understanding tax rates. The definition of tax rates. Tax rates are the percentage at which an individual or corporation is taxed. It determines the amount of tax owed based on income or profits. The importance of tax rates. Tax rates are crucial for generating government revenue, funding public services, and influencing economic behavior. Overview of my presentation. This presentation will explore global tax rates, historical trends, factors influencing changes, case studies, and the impact of these changes. Global tax rate overview. Comparison of tax rates. Developed countries typically have higher tax rates compared to developing countries, for example, India and Brazil. Types of taxes. There are 3 types of taxes: income tax, levied on individual earnings; corporate tax, levied on company profits; and value-added tax, also known as VAT, indirect tax on goods and services. Trends in tax rates. Historical changes. From the early 20th century to today, tax rates have fluctuated significantly due to wars, economic conditions, and political ideologies. High rates during the World Wars and mid-20th century were followed by reductions in the 1980s and 2000s. Recent trends focus on balancing economic growth, government funding, and social equity. Major tax reforms. The Reagan tax cuts of the 1980s. These reduced top tax rates significantly to spur growth, leading to budget deficits. Tax Cuts and Jobs Act of 2017. This lowered individual and corporate taxes to stimulate investment but increased the deficit. European VAT increases. This raised VAT rates post-2008 to stabilize finances and fund services, with rates now between 18 and 27%. Factors influencing tax rate changes. Economic factors. Inflation. Higher inflation may necessitate tax rate adjustments to maintain government revenue. Economic growth. Booming economies might reduce tax rates to encourage spending, while struggling economies might raise rates. Fiscal deficits. Governments with large deficits may increase tax rates to balance ideologies. Political factors. Government policies. Changes in administration often lead to different tax policies reflecting their economic ideologies. Political stability. Stable governments can implement long-term tax policies, while unstable ones may see frequent changes. Social factors. Public opinion. Citizens' view on taxation influences policymakers. Demographic changes. Aging populations may lead to higher tax rates to fund pensions and healthcare. Case studies. The United States. Reagan tax cuts. The Reagan tax cuts reduced top income tax rate from 70% to 28% in the 1980s to stimulate economic growth. The Tax Cuts and Jobs Act of 2017. This lowered corporate tax rates from 35% to 21%, aiming to boost investment. Now looking at Scandinavian countries. The high tax, high welfare model. Countries like Sweden and Denmark maintain high tax rates up to 60% to fund extensive social services. Recent adjustments. Ongoing tweaks to balance welfare, state sustainability with economic competitiveness. Impact of tax rate changes. Economic impact. GDP growth. Tax cuts can boost GDP in the short term by increasing disposable income and spending. Employment rates. Lower corporate taxes can lead to job creation as businesses expand. The social impact. Income inequality. Progressive taxes reduce inequality, while regressive tax policies may exacerbate it. Social welfare. High tax rates fund public services, improving quality of life but potentially reducing disposable income. Corporate impact. Business investments. Lower taxes attract foreign direct investment, FDI, and encourage domestic business expansion. Competitiveness. Competitive tax rates can position a country as a favorable business destination globally.